Hey there, Shingirai here again with another update on portfolio performance over the past week. Looking at a one-week basis, 9 out of 10 of the CBAM portfolios outperformed their respective benchmarks, with returns ranging from 0.67% for CBAM 1 V2 up to 2.15% for CBAM portfolio number 5. We saw a risk-on rally in Chinese equities, back on the base of investor confidence, driven by some strong manufacturing data through the Purchasing Manager Index, PMI, coming stronger than expectations and actually beating pre-COVID levels and restoring some faith on that China reopening trade. That would see our Chinese positions through Columbia Threadneedle and HSBC MSCI China up more than 4.5% on the week. We also saw some respite for iShares Global Clean Energy, up 4.82% on the one-week basis as well. Switching over to detractors from performance, as you would expect on a risk-on week, would see some weakness there for longer-dated US government bonds, alongside European government bonds and Japanese government bonds, there with all of those three positions being down more than 25 basis points on a one-week basis. We also saw some weakness there in terms of Japanese GDP figures, indicating a bit of a slowdown and stagnation in the economy, and also inflation higher than it's ever been since the 1980s, with a reading of about 4.3 on CPI for Japan. On a quarter-to-date basis, 4 out of 10 of the CBAM portfolios outperformed their respective benchmarks, with returns ranging from 1.9% for CBAM 1 V2 up to 4.79% for CBAM 5 V2 as well. In that coming into favor again trade, European equities also taking the limelight here, with our position through Bailey Gifford European Equity and Allianz Continental up more than 11.9% on a quarter-to-date basis, and also our Pictet Clean Energy position, which has a fairly large exposure to European equities and European energy names, also up as a leader at 3.82% on a quarter-to-date basis, but also just seeing a bit of that GDP data coming out of Europe, weaker than expected, and also just switching over to detractors from performance, we would see our rougher diversified return position down 1.63%, and that's just on the back of the longer dated inflation-linked gilts, which will constitute about 20% of the holding for the rougher diversified return, alongside a large about 15% again allocation towards gilts, which have a longer dating, being negatively affected in a rising interest rate environment. The story continues where India continues to miss that growth target, but again, inflation also being a bit more stickier than anticipated, with Indian shares down 1.01% on the quarter-to-date basis. And then finally, as I touched on earlier, longer dated gilts seeing some weakness from LNG. All-Star Gilts Index down 48 basis points on a quarter-to-date basis. And then this week, again, we're beginning to see some strain in the US jobs market, with initial jobs claims up at a reading of about 205,000 versus an estimate of 195,000, beginning to see some weakness in the jobs market as a reaction to some of the actions taken by the Federal Reserve Bank. And then tomorrow we'll be looking forward to seeing that unemployment figure and also non-farm payroll data coming out on Friday, which will give us sort of a map for the markets to follow as to where the Fed could possibly go next in their 22nd of January Monetary Policy Committee meeting.